Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in. Take a look, see what people are sharing, and I'm going to interject my financial opinions. If you want to follow me at Financial Finance, and if you want to join our community, finding-value.com, I go deeper into all of these sectors areas. I'm looking for potential investment opportunities. And it's not just the opportunities. I'm timing my purchases with those opportunities. Good technical chart setups, good fundamental companies. I'm a hybrid investor. I kind of match and mesh those two together. And if you want to learn how to invest, you can see how I am doing it. You can see what my returns are. You can see the positions when I put them on real time. I am hiding absolutely nothing on the website. I am exposing myself completely. And we've got a Discord. We've got question and answer sessions on the weekends. And we also have midweek updates where I go through a lot of the companies that we follow and I share my opinions as freely as I can. Looking at gold silver miners, we've got First Majestic Silver is a leverage play on the price of silver. Here is a plausible scenario that he can see on how First Majestic could respond to an increase to silver. This is a hypothetical exercise. Do your own research and estimates. It's not investment advice. And what he's got is the silver price on the left. And on the right is First Majestic silver stock price dollars per share. And what we're going to see is we're going to see leverage to the price move. And this is what I want you to look at. The difference here of a $5 move up, it goes up $6. So in the beginning, your leverage isn't as big. And then watch what happens. Another $5 move up, and what happens? It goes up $8. So it was $6, $8. Another $5 move, it goes up $10. Another $5 move, $12 up. And then you keep going up and you notice something. All of a sudden, every $5 move goes up. This is amplifying the move between each of these. Like this one here is a $5 move. Now it's $21. Now we come up $25, $30, $30, $35, and it goes up and up and up. That's your margin expansion of the balance sheet. Your margin goes up faster than the price of the commodity. The higher the cost producer, the faster the leverage increases with the pricing going up over here. So the difference between this and this, $6 versus 5, and then towards the end, $25 versus 5, that's a 5 times leverage move. Your higher cost producer leverage is the leverage that you get when the price goes up a lot. And when people start to look at this, and I'm just going to say this, we start at a $20 price at 35, and First Majestic is not trading at $20 right now. Look at the bottom here. That's $370 at $115. $370. This is 20. That's well over a 10 bagger. That's almost a 20 bagger off this price, let alone where the shares trade. Now, there's a lot of things that I'm doing on the website that I don't show something like this, but I know where the break evens are for some of these companies, not all of them, but some of them. I know who has the high leverage. I can see it in the technical charts. I can see it also in their presentations and their balance sheets. You can see it everywhere if you look. I am positioning myself not just in one company, but in a bunch, across a whole bunch of different sectors. This type of leverage move that you could get, or wherever it ends up, that type of leverage is your asymmetry. And that's where you make all the money. So you can spread out. You don't have to be right on all the sectors. You just have to be right on a couple sectors. And then the asymmetry carries you way on up. The strategy is absolutely fantastic. And you can take these higher cost producers. Some of them have a little bit of debt, which may even amplify the move, because on the downward moves, they can be 99% off their highs. And then when they go back up, they go up dramatically, like 10, 20% up days when the price of that commodity goes up. So I've got an entire portfolio with certain position sizes in all these, collecting them when they're cheap, buying them at the bottom. And this is one of the companies that we bought at the bottom. So, yes, miners are outperforming silver today. Remember about a breakout and then a potential retest, backtest move. What we have here is this is the Global X Silver Miners ETF. That's what we're looking at. We've got a breakout resistance area. So we have a resistance up there that's that green dotted line here. We've got volume confirmation where a lot of people are coming in to buy this. Generally, smart money. I'd also say volume was kicking up over here. I would have purchased it even down in this region of this breakout there. You've got volume kicking up, and then the volume came in all after this. But you usually get a retest. So you break out, and then you get a retest, and then you come back up. Don't get too discouraged on the retest, guys. I know a lot of people look so short term. You got to look at the big picture view. You got to look at the volume confirmations. You got to look at the big, big picture. This is SIL, I believe. Here's platinum. Breakout looks imminent. Pennant targets about $2,000 an ounce in his opinion. The way that he projected it is you take the entire move of the pennant, and then you take it and put it from the bottom up. $2,000 move. Now, from a ratio perspective, we are incredibly cheap against gold, incredibly cheap against silver, incredibly cheap against palladium. Platinum is going to do some crazy things. And what you want to see is you want to see this squeeze into a corner, just like it is. And then you want to see bigger buying pressure with smaller selling pressure, just like it has. And then you want to be right up against resistance, just like it is. And then you want to break out of all of it. And then it will probably break out. It could do a back test and then run. So that's what we got. That's what we got going on with platinum. It looks fantastic. Peter Schiff says stock market investors are finally paying attention to the carnage in the bond market. The sell-off will likely continue until the Fed comes to the rescue with some dovish talk about future rate cuts. When that fails to turn the bond market, the Fed will resort to full-blown QE. Now, if they do full-blown QE to hold interest rates down, guys, that's that pressure. So the pressure is building in the bond market right now. That's why interest rates are going up, up, up. Nobody wants to buy the bonds. And they're going to come out, they're going to say, blah, 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 rate cut, and then maybe some people will position. They're trying to talk the market into buying bonds. If that fails, then they have to resort to full-blown quantitative easing, where they get into the market, they print a bunch of money, and then they buy stuff. And what that does is it transfers the pressure in the bond market into the currency markets. So the dollar is what's going to be the relief valve when that occurs. If it's not occurring now, the dollar is going to continue to strengthen until they do that. Now, if they do full-blown QE, what does that mean? It means that the value of the dollar is going to go down. It means that they're going to sacrifice the dollar to save the bond market, and they're going to save the stock market in the process of doing it because increased interest rates weigh on the stock market. If they do this decision, and in the situation that we're in, they're going to send commodities and precious metals to the moon. And that's going to be driven by the denominator, the value of the dollar, and those commodities are priced in dollars. So they're going to transfer the pressure from the bond market to the currency. That pressure is going to put pressure on the currency to go down. And that's where you're going to see a devaluation of the dollar, and you're going to see precious metals go ballistic goose. These things are going to rip. If we're talking about a crisis, here's another one. China M2 money supply is up 2.1 trillion in 2 months, just ripping higher. They're going through a deleveraging phase in their real estate market. It's deflation. And what they're trying to fight that deflation with is increased money supply growth. Most of the time it doesn't work. and that money might just slosh around in financial assets. So I think that they are very similar to 2009, 2010, 2011. It takes years to get out of this, about 4 or 5 years. But I will say the demographics in China still look very weak. So they could be entering something like Japan did in the 90s, 2000s. So we've got Brandon. He says, "Here we go, folks. Silver juniors are breaking out versus the S&P 500. Momentum begets momentum. HFs and institutions chase relative performance to keep their jobs and fees." It says, and what's been working lately? Precious metals and miners. Small market plus big inflows equal a rocket. And here we are. We put in a big bottom. It looks like to me like a shoulder, a head, and a potential shoulder, and then the breakout. We could get a retest. Don't be afraid here of the retest. SIL-J versus the S&P, we're going to see a big, probably outperformance coming up here. Big, big, big. It does hinge on some of the stuff that we just covered. This QE here, if they do this, guys, that's when we go, guys. That's when this goes vertical goose. That's when it rips. And I don't know how they're not going to do that. They're in a difficult situation where it's not about having a solution. A lot of people say, well, what's the problem? We'll have a solution. They're in a predicament where they're going to have to start to handle outcomes. Predicaments don't have solutions. They have outcomes. And I think that we are at that spot where they're in a predicament where they're going to have to start to handle outcomes. And outcomes mean that they're going to make a decision and sacrifice something. Maybe it's sacrifice the value of the dollar or sacrifice the economy if they keep interest rates high, or try to, you know, be right on the razor's edge where it may or may not work is where they're at. The platinum, so is platinum gearing up to join the metals party with gold and silver? Prices breaking out to its highest prices since early July right now. He's got a shoulder, head, shoulder. We can see, obviously, there's things that we have looked at for doing downward breakouts. So it looks really good. Looks really good on a variety of ways of looking at it. Baker Hughes sees global energy demand rising, but oil demand being flat. I think they're right about energy demand rising, and he didn't make a comment about oil demand. I will say this. If you look at evidence and say, where has oil demand fallen from? There isn't a single country in this world that has falling oil demand. It's all been going up. And we're talking about countries that have adopted a lot of electric vehicles, and those electric vehicles have not declined the demand for oil. They have, Norway has gone sideways, but it hasn't actually contracted it. So I am doubtful that in the short term we are going to see a decline in oil demand. But this is obviously with natural gas and a bunch of other things. We've been just ripping higher here, guys. Ripping, ripping, ripping. Natural gas, 20%. LNG plus 75%, oil flat is what their expected growth is between 2023 and 24. Or 2040, sorry. 80% of the world's oil and gas supply coming from mature fields. Customers spend more to boost existing field recoveries, says Baker Hughes. Keep that in mind. The demand can be flat, but if we can't grow this, there's your problem. There is zero chance I'm paying off my 3.5% 30-year fixed mortgage early in exchange for better sleep at night. I would rather hold the 30-year short position on the dollar with a carry cost of 3.5%. Don't listen to Dave Ramsey or Better Sleep at Night bros or trap mentally, however say that, doomers that LARP about freedom from debt. I'm holding on to mine. I've got a 2.75% 30-year, and I'm just paying the minimum. I'm letting the inflation eat this thing away. This is what I'm doing if you guys want to know how I'm doing it. I'm taking the difference that I would be, if I was applying it to my mortgage, I can take money and invest it. I'm investing it in dividend paying companies. The dividends that I am receiving are somewhere between 8 and 20%, depending on the companies that you're looking at. Those dividends are subjected to the price of the commodity. So they do vary up and down. And if we do get a big commodity bull market, keep in mind that commodities generally follow gold higher, and gold has been ripping. So I am in the camp that we're going to see higher commodity prices because gold's been moving up, just like all the other bull markets. And my dividend yield, my dividend payouts will continue to go up with the price of the commodity. So when I get these early entry points, I might be getting a 8% dividend yield, but by the end of the bull market, on the money that I put in originally, it is possible that I get my entire investment back in a single year from dividends. It is possible. I'm not saying all the companies, but there will be companies that I am getting larger dividends back per year than my entire investment in the company. And I've already experienced some of that with some of the companies already. Gas turbine sales are booming, says Bloomberg. It says annual global orders on track for 60 gigawatts for 2024, 2026. They're up 50% from previous years, says Mitsubishi Power. Countries are turning to gas-fired power to replace coal to feed the data centers. It's like I already knew that before it was coming. Do you know how I knew that? Because they have to do that. I knew that they were replacing coal-fired power plants. I know people in the energy utility business. And then the data centers are just going to amplify it. That's all. Rock Bottom Entry says, try and sell the exact top of this rally and you risk losing your ticket. That's called losing your position. Ride the uptrend and get off when it breaks down. It's that simple. Most don't have the emotional discipline to just sit in a bullish trend. Guys, do nothing. Do nothing. Do not mess this up. If you've got great entry points in whatever sector you've got, your best offense is to do nothing. This isn't like going to work and trying to improve the process or to improve something at work. This is the exact opposite. It's like you get a really good position and then you just sit and hold. You sit and wait. You watch paint dry. It's pretty boring. Go do something else. Go have fun. Go outside. Take a walk. Do whatever you can. But keep that position on. Bonds. So Warren Pye says many are misinterpreting recent price action. The move from 3.6 to 4.25 in the 10-year post-Fed cut does not signal a policy mistake. Instead, it is the unwind of recession insurance buyers. So his conclusion is what he has is it's the unwind of recession insurance buyers is what he says. Says hedge funds have built a record short position in crude oil. We expect a pre-election rally. More next week. Nice. North Star, Bitcoin has entered a bear market territory priced in silver. So when you start to price these things, in gold or silver or whatever, you start to break down and they show different chart patterns. Silver's been ripping it. Bitcoin hasn't been. It's been basically in a big flag pattern. We'll see if this changes this dynamic, but right now it is broken the support trend line. To deal with our coming debt crisis is by restructuring. We need higher interest rates, but debt is too high to allow that. So we need an Treasury bondholders lose either way. It's preferable for them to lose through default rather than by inflation. It says oil will catch up soon, and what is this? He's got the WTI versus the 10-year Treasury yield. The 10-year has been moving higher, but we went lower in oil price. He thinks that that's going to continue higher. I'm of the camp that oil generally leads interest rates, like back here. And here, you can see interest rates popped higher here, but that was from this move up. So oil generally leads interest rates. It doesn't follow. But maybe oil's being held down to some extent with the election or something. Maybe it does rocket higher. Jordan says the most important chart in gold, which is an update here, not at the end of the month yet, but this baby's getting closer to confirmation. This is gold versus the 60-40 portfolio total return. Secular bulls in precious metals lasted another 8 and 10 years after the confirmation move. So when this confirmation move breaks, much like this confirmation in 2002, so let me just sum some things up here. This is when the dollar broke down. Remember when I was talking about the bond market up above? The bond market broke down in '02 too, and they transferred the pressure in the dollar. The dollar broke down in '02 all the way up to about 2011. We've got a similar situation here. This is one big double bottom. Draw a line across bottom one, bottom two, and we could have a big move. Look at the y-axis here, 2.59, and this is up around 60 or something up here. That's ridiculous. This is the 60-40 portfolio. You can see the other big move in 72, and then we had another big move here, a trend line break in about late 70s up to early 80s. We have a big move here, guys. It's going to be a fun ride. Going to be a fun ride. Bullish trend, API inventories, about flat here for this one. And it says, remember, we're in building season. We're supposed to be building inventory. If we don't build inventory, we're just setting up a huge bull market in oil. Huge bull market. Rick Santelli is on a roll tonight explaining why we will need higher yields to sell our treasuries. He even mentions it doesn't take much of a disturbance to take yields from 5% up to 15%. No one wants to believe this, but it's true. That's a big move. That's a big move if that happens. Meb Faber says, number of times when both gold and the S&P 500 are up 25% in the same year. Zero. The SPY is up 24% or so this year, with gold up about 33%. And what we're measuring is what? The market conditions. Gold goes up when yields uninvert. That's generally when stock markets fall. And the reason he's saying this is because that market condition does not usually lead to an SPY up. And that's why I keep saying the plunge protection team is in there buying stuff. Because we've got gold going up, yields going down, and all of that. It's like, I don't know how this is up. I don't. But I guess if they print enough money, maybe it's nominally, it's hidden. So then you look at the S&P 500 divided by gold, and gold's starting to outperform. Grady says the silver miners ETF SIL is breaking out hugely. We bought the very lows at the service back in Feb March. Make sure you don't miss this move of a lifetime. And here we are breaking out in SIL. And SIL and SILJ, they share a lot of companies, if you want to know. Update on my pin chart, inflation-adjusted gold price, look out, and here we are breaking out. That's going to be great for the mining companies. Inflation-adjusted price. Look at the inflation-adjusted price back in 1970. That big move there. We have something very similar happening right now. Big moves are going to occur in the mining companies and royalty companies. Big moves. API crude build is much lower than we had expected. The next few weeks will be very important as U.S. oil production is expected to start increasing. If EIA reports lower builds than our forecast, then it implies U.S. oil production is not growing. See excerpt from our OMF today. Kevin says, gold and silver bull markets are so powerful because people don't just greed buy, they fear buy. Watching your savings and wages deteriorate in front of your eyes while the price of goods you need go up week after week is psychologically traumatic. The herd is going to panic buy, and we aren't even close to that yet. The buy the dip generation is clueless as to what is coming. And that's where we're going to end it there, guys. We're going to end it with Kevin and his talk there. Give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.